Welcome everyone, another great video. In retirement, lots of decisions you have to make, one of which is you're taking money out of the portfolio, and sometimes the markets can be volatile. No one wants to sell when a stock or an investment is down. How do you handle all of that? Well, that's what we're going to get into today. How to do some safe withdrawals from your portfolio. We'll just dive right in here, Kevin. One concept is what's known as a cash buffer. Maybe you hear cash damming or different terms for it, but the idea of having a little bit of a cushion to help with those withdrawals during times of turbulence.
Yeah, and I mean, the cash buffer can be a variety of different things. I mean, part of it could be part of an emergency fund. It doesn't have to be, but it could also be a cash buffer specifically because you are taking money out on a regular basis in retirement. So again, having a little bit of cash in your portfolio is never a bad idea. It gives you some options. A, in case you need the cash to pull out. B, having cash if markets are down, maybe a good option to buy later because you have that actual cash. But having somewhat of a buffer is a big advantage to going forward because it does sort of give an insulation towards your portfolio as a whole. Because cash, unless there's any sort of scenario, doesn't really ever go down. It's always there at that sort of point. But a cash buffer is a nice idea to have.
And the idea is that you retired for many years, but often decades. So you might need to have some stock or some kind of little more volatile investment in the portfolio because longer term it gives you that growth. But if you're taking money out every month, that volatility can work against you. So it's trying to how do you bridge that gap? We'll go through a quick example here. It's pretty straightforward. John and Karen in this example, they're retired. They get some CPP, some old age security. They get some pension from John's employment, but then they need to top all that off, 20 grand a year from their investments, Kevin, and they have $500,000. So that's the part we're going to focus on, the bolder part, the 20,000 a year from that portfolio of 500,000. We'll pull up a few examples here. So this is the first portfolio. That's pretty straightforward. They've got some stocks. They got some alternative investments. They have some fixed income. And then I'll flip to number two. You can talk us through it here. This would be when they introduce that cash buffer. They trim a little bit of the investments and add another wedge there, highlighted in yellow here. So now they can leave the other investments alone, and they have a couple of years, in this example, 2 years worth of payments kind of sitting there. So if it's a bad time, they can take from that wedge and allow the other investments to continue to recover. Does that make sense?
Yeah, I mean, it's perfectly normal to have that sort of a scenario go on, to put that cash buffer in there. And again, if you notice the way we've taken the cash buffer, we've taken a little bit from everything. We didn't take it all from the stock side. We didn't take it all from the fixed income side. We took a little bit from everything so that we can sort of maintain that balance that you had beforehand. But again, having that cash buffer there does give you a variety of different options. As Clint said, if you have monthly withdrawals, in the example where we need 20 grand, here, we've now got 40, a little bit excess over there. That 20 grand will be met out of that. We don't have to worry about selling in a bad market. And that way we've got money that's there. It provides us what we need going forward. And also there's a little bit of an extra buffer beyond that because you never know. Like I said, you could want to buy back in at a lower rate or something along those lines with some of that excess cash, or maybe something comes up, an emergency or something along those lines. So having that wedge in there is really nice to deal with, especially in that retirement time frame. But as Clint mentioned before, you don't want to go fully cash. It's not like, okay, I stopped working. Now I just put everything in cash and GICs and leave it there. No, you still need to have stuff that grows over that time frame to keep up with inflation and things along those lines. But the cash buffer is important to put together so that you do have a little bit of that excess if you need it.
Yeah, it's time frames, right? Your portfolio can still be longer term in retirement. You got a few decades ahead of you, but you do need some more immediate needs. For example, most folks take money out every month from the retirement portfolio. So how do you bridge the gap while having a little wedge in the portfolio? Could be one way to do that. But what does that wedge invest in? It was yellow in that prior chart. We're saying cash buffer. It doesn't necessarily have to be just cash. It simply the concept is lowering the risk, right? Maybe it's in a GIC. You got part of it in a GIC that comes due in a year, or maybe you have some of it in a money market fund or high interest savings or other fixed investment. The idea is it's something low risk that's easily accessible that could help fund some of your payments if the other stuff is being turbulent. So what would you want to put in that category? I mean, the fixed income kind of covers it?
Yeah, I mean, and it's sort of that two-pronged effect. The one thing that you do want to make sure of is, A, it is liquid. I mean, you want to have access to that cash. So if you are looking at the GIC, maybe it's a short-term thing or something that's 30-day cashable, because, you probably don't want to go 5 years with that, especially if you're needing money on a regular basis. As you mentioned, the money market fund or the high-interest savings account probably give you better than what the bank savings rates will be. And again, those are fairly liquid. So liquidity is a very big deal with this. And that's something that I think you really have to look at. But you're right. I would be looking at it as more of a fixed income play for that safety first. Sure, bank stocks have done well. They pay a great distribution, but you can also get them going down 10 or 15%. And the thing we're trying to do here basically is lower that risk, get that safety first aspect. That's why you want the cash, because you're going to need it down the road possibly. And so by investing it in something that's a little safer, that gives you a little more option that way, probably is the best way to buffer your investing.
Yeah, you hit it right on the nose. There's safety and then liquidity, and I'd say time frame as part of that aspect. Time frame, liquidity kind of go together, but
Yep.
safety first, and then you have to be able to get access to those funds. Otherwise, it defeats the purpose. We get questions like this all the time. And if you have a question on this topic or any others, please visit us, chatwithclintonkevin.com, bottom of the screen there. Would love to hear from you. It's part of our website. Fill in the form, comes right to us. We get back to everyone that sends us a question. So please do exactly that. Chatwithclintonkevin.com. On the cash buffer, we have an idea of what it is, the kind of role it could fill within a portfolio. This is kind of the big question as well. How big should it be, right? And there's no perfect answer. Some folks say, you know what, I just need a couple of months payments there. So if things are turbulent, I can just keep getting my monthly payments out of the portfolio and not worry about everything else. And others say, well, I want half my portfolio in some kind of slow risk buffer, so I have 10 years worth of payments and I don't have to worry about it. And I think it really comes down to the idea of risk, right? Because essentially you're lowering the risk of the portfolio by having more and more in this kind of buffer, low risk zone. The more you put there, well, theoretically, your potential return is going to go down over the long term because you have more and more in the low risk category. But it's a comfort zone, right? It's the trade-off, right? Less risk. Not necessarily a bad thing. It just means you have more and more set aside as a lower risk portion of your portfolio.
Yeah, the risk factor is the big decider, right? I mean, if you want less and less risk, you're getting older and older and you're worried I'm not going to be able to survive with this, then yeah, you're going to have a larger cash buffer, a larger fixed income side of things, because you want something that generates, even if you're not getting the gains anymore. So that's fine with me as long as I've got some money coming out. Whereas, as you mentioned before, if I only need 3 months worth of money, I'll keep the rest of it in the market because I know things can go from there. I don't have to worry about that risk factor as much. I know what's going on. And again, those all tend to have a little bit of a change depending on what the market situation is like now. I would say that there's a lot more people that are a little more or a little less risk averse today than they would have been, say, 2 years ago when everything seemed to be moving in the right direction. So that may increase your cash pool as well. But again, your risk factor is the big decision on how much cash you really want to keep. If you think you need a year's worth of cash there because the markets may not turn around, do it that way. That's going to have an effect on how much cash position you have, but also what your return is going to be in the end.
Yeah, and it's comfort factor, right? What lets you sleep at night? Everyone's going to be a little different with that, but just the concept of having one in the portfolio would make sense. The size of it is really up to you and your overall plan. I'll pull this up just to reiterate that yellow piece. So we have all the different assets. These are very broad categories. We're just doing that for an example. And then that yellow piece there, that's the part we're talking about. Eventually that gets used up, Kevin, and you're going to have to rebalance it. So it's not a one and done. Eventually, there's going to be a factor where, okay, well, we've spent all that cash. We've taken it all out. Now we have to trim the other investments to replenish that sector. And effectively, what you're doing is you're introducing that wedge. You're adding another asset class or another version, which you're just diversifying and you're lowering the risk. So it's not like it's a magic cure-all solution here. Effectively, you're just lowering the risk of the portfolio by having that additional diversification, because eventually you're going to have to rebalance. You're going to have to sell some of the other assets to replenish this cash position. So it's going to end up being effectively lowering the risk of the portfolio, which makes some sense, right? You're taking money out by introducing the cash buffer. You're effectively just lowering the risk of the account, which would make sense when you're withdrawing from the portfolio. Anything you wanted to add to that?
Yeah, I guess your biggest point there is to remember that this is usually not a one and done. That's the one thing to remember. You take the one-time cash. Oh, I put the 40,000 there. I never have to do it again. Well, when it's gone, you really do have to do it again if you want to keep that cash buffer zone. So it is not a one and done. It is something that you plan out going forward. That's part of what you want to deal with for your retirement planning sector as well, and how things can be dealt with there. So again,
the magic word, Kevin, right there.
The Becker or mantra, as always, is to have a plan and then make sure you deal with it. And that'll also help in deciding how you start to draw things down. But we have videos on that, don't we, Clint?
Absolutely. If you love this video, because we talked about how to get money safely out of the account by introducing the buffer, well, the next question is, well, what account do you start with? Is it the TFSA? Is it the RSP? What about the tax? We have a video exactly on that, how to handle withdrawals, floating on the screen, probably over here, maybe over Kevin, wherever it is. Click on it. We'll see you then. Take care, everyone.